There's a secret in the world of finance, a quiet, almost invisible truth that your broker, your financial advisor, and the entire ecosystem of flashing tickers and breathless market commentary hopes you never fully grasp. It's not a secret about a hot stock tip or a complex trading algorithm. It's simpler and far more powerful. It's the secret that the most profitable action an investor can take, day after day, week after week, is very often no action at all. This principle is the bedrock of Warren Buffett's entire philosophy, the engine that turned a few $1,000s of savings into a $100 billion fortune. It's the idea that the market is a battlefield, and on that battlefield are countless hidden taxes and tolls designed to slowly bleed you dry. Every time you trade, every time you click buy or sell, you are paying these tolls. You pay them to your broker in commissions, you pay them to market makers in the spread between the bid and the ask, and, most devastatingly, you pay them to the government in the form of capital gains taxes. Buffett understood that minimizing these frictional costs wasn't just a minor optimization, it was the entire game. He saw that most people in the market behave like what he called in-and-outers, flitting from one idea to the next, convinced that activity is the same as progress. They enrich their brokers, they enrich the government, and they wonder why their returns never seem to match the market. Buffett chose a different path. He chose to be a business owner, not a stock renter. He made very few decisions, but the ones he made were exceptionally good. And then he did the hardest thing in all of investing. He sat still. For years. For decades. He let the silent, unstoppable power of compound interest work its magic on his capital, uninterrupted by the constant siphoning of costs and taxes. This is the transformation that awaits you. By the end of this journey, you will no longer see the stock market as a casino for quick bets. You will see it as a vehicle for owning pieces of wonderful businesses. You will understand that inactivity is a strategic weapon, that your patience is your greatest edge, and that true wealth building is not about frantic action, but about profound, disciplined, and profitable stillness. You will learn how to stop trading and start owning. The most insidious costs in life are not the ones that arrive as a large, shocking bill. They are the ones that bleed you slowly, the tiny, almost unnoticeable drips that, over time, can drain an entire reservoir. In the world of investing, this reservoir is your capital, your hard-earned money that you are trying to grow into a foundation for your financial freedom. And the slow, steady drip is the tax of hyperactivity. To truly understand this, we must go back to a moment that redefined the entire debate between active and passive investing. A moment orchestrated by Warren Buffett himself. It wasn't a stock pick, it was a bet. In 2007, Buffett made a public wager that would run for a full decade. He bet $1 million that a simple, unmanaged, low-cost S&P 500 index fund would outperform a portfolio of hedge funds, hand-picked by an investment firm called Protégé Partners. This was a direct challenge to the very heart of Wall Street. The hedge fund industry is built on a narrative of genius, of superstar managers who, through their brilliant insights and rapid-fire trading, can outsmart the market. They are the epitome of action. They employ armies of analysts, build complex quantitative models, and execute thousands of trades. And for this service, they charge fees that are orders of magnitude higher than a simple index fund. They typically charge 2 inches, a 2% annual management fee on all assets, plus 20% of any profits they generate. To Buffett, this was institutionalized hyperactivity, and he believed the costs associated with it would act as an anchor, dragging down performance over the long term. The bet began just before the 2008 financial crisis, a period of immense volatility that should have been the perfect environment for skilled active managers to shine. The narrative was that in a downturn, these brilliant minds could navigate the chaos, shorting stocks, moving to cash, and protecting their clients from the storm. The passive index fund, by contrast, had no choice but to ride the market all the way down. In the first year, as the market crashed, the hedge funds did indeed lose less than the S&P 500. The proponents of active management declared an early victory. They had proven their worth, their high fees, justified by their defensive prowess. But Buffett's thesis was not about a single year. It was about the slow, grinding, relentless effect of costs over time. He remained silent and let the bet play out. As the years went on, a strange and powerful truth began to emerge. The market recovered, and the S&P 500 began its steady climb. The index fund, with its minuscule annual fee of just a few hundredths of a percent, simply tracked the market. It did nothing. It made no brilliant trades. It held the same large American companies, day in and day out. The hedge funds, meanwhile, were a whirlwind of activity. They were buying, selling, hedging, and shorting. And with every action, they were incurring costs, brokerage fees on their trades, research costs for their analysts. And, of course, the massive 2 and 20 fees paid to the managers themselves. These costs were a constant, gravitational pull on their returns. Even when they made a brilliant call, a significant portion of the profit was immediately consumed by the fee structure. Over the 10-year period, the result was not just a victory for Buffett, it was an annihilation. The simple do-nothing S&P 500 index fund returned an average of 7.1% per year. The sophisticated, hyperactive portfolio of hedge funds returned an average of just 2.2% per year. An investor with $1 million in the index fund would have ended the decade with nearly $2 million. The same investor in the hedge funds would have had just over $1,200,000. The difference, hundreds of thousands of dollars, had not been lost to bad decisions necessarily. It had been transferred. It had been paid to the fund managers, to the brokers, to the entire infrastructure that profited from activity. Buffett's million-dollar prize money, which grew alongside his S&P 500 investment to over $2 million, was donated to charity. He had proven, in the most public and undeniable way, that the invisible tax of hyperactivity is the single greatest enemy of the long-term investor. The greatest irony is that the high-paid managers at Protégé Partners were not stupid. They were victims of the same psychological flaw that plagues millions of individual investors. The core reason we fall victim to this tax of hyperactivity is a deep-seated cognitive bias known as salience bias. Our brains are not wired to give equal weight to all information. We disproportionately focus on things that are flashy, exciting, novel, and emotionally resonant. In the context of investing, the potential for a massive gain on a stock is incredibly salient. You see a headline about a company with a new breakthrough product. You see its stock chart jumping on your screen, and you imagine the thrill of doubling your money. This potential reward is vivid, exciting, and occupies a huge space in your mind. What is not salient? The 0.1% commission fee, the tiny half-a-penny difference between the bid and the ask price. These things are boring, small, and mathematically abstract. They don't trigger any emotional response. So our brains effectively ignore them. We make a decision based almost entirely on the salient information, the potential upside, while disregarding the guaranteed, albeit small, downside of the transaction cost. This is compounded by the availability heuristic, which is our tendency to judge the likelihood of an event by how easily we can recall examples of it. The financial media bombards us with stories of traders who made a fortune on a single, brilliant move. We hear about the person who bought a meme stock at the perfect moment, or the day trader who predicted a market turn. These stories are available. They are constantly pushed into our consciousness. What we don't hear about are the millions of trades that go nowhere, the millions of times those small commissions and spreads ate away at capital, resulting in a net loss or a mediocre gain. The silent, steady success of the buy-and-hold investor who does nothing for a decade is not a news story. It's not available to our memory. So when we are faced with a decision, to trade or not to trade, our brain recalls the exciting stories of successful action and discounts the boring, invisible reality of compounding costs. This creates a powerful illusion that the path to wealth is paved with frequent, clever decisions. The brokerage industry is built on weaponizing these biases. Their platforms are designed for salience. They use gamification, confetti animations for completed trades, and constantly updating price charts to make the act of trading feel exciting and important. They are creating an environment where your natural cognitive biases are amplified, encouraging you to focus on the thrill of the action and ignore the slow drain of the costs. Overriding this requires a conscious, deliberate effort to make the invisible visible. To break free from this trap, you need a practical tool, a mental model that forces you to confront the reality of these hidden costs. We can call it the frictional cost audit. This is not an estimate. It is a precise, surgical examination of how much your activity is truly costing you. It's a blueprint for turning the invisible into a concrete, unavoidable number. Here is the step-by-step process. First, you must gather your data. Log into your brokerage account and download your transaction history for the last full calendar year. You're looking for every single trade, every buy, and every sell. Step 1 of the audit is to tally the explicit commissions. Go through your statements line by line and add up every single commission fee you paid. Whether it was $5 a trade or $0, get the exact number. Many brokers now offer commission-free trading, but this is often a marketing sleight of hand, which brings us to the more difficult part. Step 2 is to estimate your implicit costs, specifically the bid-ask spread. For every trade you made, you need to go back and find the bid and ask price at the moment of your transaction. The difference between the price you could buy for the ask and the price you could sell for the bid is a hidden cost you paid to the market maker. For liquid stocks, it might be a penny. For less traded assets, it can be much larger. Calculating this precisely for past trades is difficult, but you can create a conservative estimate. A reasonable rule of thumb for an active trader in common stocks is to assume a cost of 0.05% to 0.1% of the value of each trade. Multiply this percentage by the total dollar value of all your trades for the year. This number will likely shock you. Step 3 is to calculate your performance drag percentage. Add your total commissions from Step 1 to your estimated spread costs from Step 2. This gives you your total frictional cost for the year. Now divide this total cost by your average portfolio value for that year. The result is a single, powerful percentage. It might be 0.5%, 1%, or even higher if you trade frequently. This percentage represents the guaranteed headwind your portfolio had to overcome last year before you even had a chance to make a single dollar of profit. It is the invisible tax made visible. But the final step is what transforms this from an intellectual exercise into a profound behavioral change. Step 4 is to project the drag. Open a compound interest calculator and input your current portfolio value. Assume a reasonable market return, say 8% per year, over a 30-year investment horizon. First, calculate the future value with that 8% return. Now do the same calculation again, but this time, subtract your performance drag percentage from the annual return. So if your drag was 1%, you would calculate the future value using a 7% return. The difference between those two final numbers is the true long-term cost of your hyperactivity. It will not be a small number. It will be tens of thousands, hundreds of thousands, or even millions of dollars. It is the price of your financial freedom, handed over to brokers and market makers, one tiny, invisible transaction at a time. Performing this audit transforms your relationship with the trade button. It's no longer a button of opportunity. It becomes a button with a clear, quantified cost attached. The path of the 99% is paved with the belief that this constant activity is a sign of sophistication. Let's create a portrait of the typical individual who lives and breathes this antithetical approach, the active trader. Their day begins not with a cup of coffee and quiet reflection, but with the frantic glow of a pre-market data screen. They are not investing in businesses. They are betting on squiggles. Their vocabulary is filled with jargon like moving average convergence divergence, stochastic oscillators, and Fibonacci retracements. They believe they can predict the unpredictable, that they can discern patterns in the random noise of the market that millions of other participants and supercomputers have somehow missed. Their core belief is that more information and faster action create an edge. They subscribe to multiple real-time news services, pay for expensive charting software, and often have a multi-monitor setup that looks more like a NASA command center than a personal finance tool. They listen to market gurus on television who shout about the trade of the week, and they treat these pronouncements with the gravity of divine revelation. When the market opens, their adrenaline spikes. They execute a dozen trades before lunch, scalping tiny profits, cutting small losses. They feel a rush with every winning trade, a jolt of dopamine that validates their skill and intelligence. They conveniently forget that the small losses, compounded by the constant drip of commissions and spreads, are steadily eroding their base of capital. Their portfolio has an incredibly high turnover rate. They might own a stock for a few days or even just a few hours. They have no concept of what the company they are trading actually does. To them, Apple Inc. is not a global technology giant with a powerful brand and immense cash flow. It is simply a ticker symbol, AAPL, a series of candlesticks on a chart. They are the ultimate stock renter. They have no pride of ownership, no long-term conviction. Their allegiance is to the volatility of the moment. This approach is a relentless, uphill battle against the invisible tax of hyperactivity. Imagine a speedboat racing a massive cargo ship across the ocean. The speedboat is the active trader. It's fast, exciting, and creates a huge wake. It darts left and right, constantly changing direction in response to every wave. The cargo ship is the buy-and-hold investor. It is slow, boring, and moves in a straight line. From the shore, the speedboat looks impressive. But what you don't see is the fuel gauge. The speedboat burns an astronomical amount of fuel for every mile it travels. The cargo ship, with its massive, efficient engine, moves slowly but consumes a fraction of the fuel per ton-mile. Over a short distance, the speedboat might seem to be winning. But across the vast expanse of the ocean, it will run out of fuel or be forced to constantly stop and refuel, while the boring cargo ship, laden with wealth, plods steadily and inevitably toward its destination. The active trader is in a constant race against the drag of their own activity, a race that, as Warren Buffett's hedge fund bet proved, is almost mathematically impossible to win over the long term. The financial connection between this principle and your net worth is not theoretical, it is a brutal mathematical certainty. Let's quantify the impact of this invisible tax with a simple, powerful example that every person aspiring to wealth building must understand. Consider two investors, both starting their journey with a $50,000 portfolio. Both are skilled enough to generate a gross return of 10% per year on their investments before any costs are considered. The only difference between them is their strategy. Investor A is a follower of the Buffett philosophy. She adopts a low-turnover, buy-and-hold strategy. She carefully selects a diversified portfolio of quality assets and plans to do very little trading. Her portfolio turnover is about 10% per year, meaning she only sells and replaces about 1/10 of her holdings annually. Her total frictional costs, commissions and spreads, amount to just 0.10% of her portfolio value each year. So her net return is 9.9% per year. Investor B is the active trader we profiled. He believes he can enhance his returns through frequent trading. He is constantly buying and selling, chasing trends and reacting to news. His portfolio turnover is 200% per year, a common figure for a very active retail trader. This means he buys and sells the equivalent of his entire portfolio's value twice over in a single year. His frictional costs from commissions and spreads are much higher, totaling 1.5% of his portfolio value annually. His net return, therefore, is 8.5% per year, 10% gross return minus 1.5% cost. On the surface, the difference between a 9.9% return and an 8.5% return seems small. It's just 1.4 percentage points. Many would argue that the potential for a huge gain from one of those active trades is worth that small difference. But this is the lie of linear thinking in a world of exponential growth. Let's see what happens over 30 years, the typical time horizon for achieving financial freedom. Investor A, with her 9.9% net annual return, sees her $50,000 grow to approximately $819,000. She has turned her initial stake into a substantial nest egg, a testament to the power of high returns with low friction. Investor B, with his 8.5% net annual return, sees his $50,000 grow to just $578,000. The difference is $241,000. That is $250,000 that vanished into thin air. It didn't disappear because of bad stock picks. Remember, both investors had the exact same skill in generating a 10% gross return. That $250,000 difference is the accumulated, compounded total of all the small, seemingly insignificant brokerage fees and bid-ask spreads paid over 3 decades. It is the direct financial consequence of choosing activity over patience. It is the wealth that was transferred from Investor B to the financial intermediaries who happily facilitated his hyperactive strategy. This isn't just a line item on a spreadsheet, it's a house. It's a child's college education. It's years of comfortable retirement. Understanding this direct financial connection is the first, and perhaps most crucial, step in aligning your portfolio management with the principles of the world's greatest investor. It forces you to see every transaction not for its potential upside but for its guaranteed cost. Beyond the visible friction of commissions and spreads lies a far more formidable adversary, a partner that the government forces upon you in every single profitable transaction, the taxman. If frictional costs are a slow leak in your financial reservoir, capital gains taxes are a giant siphon, capable of draining your wealth at an alarming rate. Warren Buffett considers the deferral of taxes to be one of the most powerful, yet least understood, levers of wealth creation. His entire career can be viewed as a masterclass in minimizing the tyranny of the tax code. And there is no better illustration of this principle than his investment in the Washington Post Company. In 1973, the stock market was gripped by fear. The Nifty 50 bull market had collapsed, and pessimism was rampant. It was a time when most people were selling, convinced that the world was falling apart. But Buffett, acting on his famous maxim to be greedy when others are fearful, saw an opportunity. He saw the Washington Post not as a volatile stock, but as a phenomenal business with a powerful monopolistic franchise in its city. He began to buy shares aggressively. Over the course of the year, Berkshire Hathaway invested $10.6 million to acquire a substantial stake in the company. For many investors, a purchase like this would have been the beginning of a series of trades. As the stock inevitably recovered and doubled, they would have been tempted to sell a portion to lock in a gain. When it tripled, the urge would have been even stronger. They would have felt smart, booking profits along the way. But Buffett did nothing. He understood that every time he sold a share for a profit, he would have to write a check to the U.S. Treasury. That check would represent capital that was being permanently removed from his control, capital that could no longer work for him and compound. So he held. He held through the 1970s, through recessions and inflation. He held through the bull market of the 1980s. He held through the dot-com bubble and its collapse in the 1990s and early 2000s. For over 3 decades, he treated his stake in the Washington Post not as a trading vehicle, but as a permanent holding, a piece of a business he was proud to own. Let's look at the result. By the time of his 2004 letter to shareholders, that original $10.6 million investment was worth over $1.2 billion. That is a return of more than 11,000%. The truly staggering part, however, is the tax implication. Because he had never sold a single share, the number of dollars he had paid in capital gains taxes on that $1.2 billion profit was precisely zero. He had, in effect, been granted an interest-free loan from the government for over 30 years on the taxes he would have otherwise owed. That deferred tax liability was money that continued to work for Berkshire Hathaway, compounding year after year. Had he been an in and outer, selling and rebuying, crystallizing gains along the way, a huge portion of that $1.2 billion would have been siphoned off to the IRS. The final amount would have been a fraction of what it became. The story of the Washington Post is the ultimate foundational anecdote for understanding the power of tax deferral. It demonstrates that the most significant drag on an active investor's returns is often not their trading fees, but the taxes they voluntarily choose to pay by constantly churning their portfolio. Buffett's genius was in realizing that a tax deferred is a tax reduced, allowing the miracle of compound interest to operate on a much larger capital base for a much longer period of time. The reason so many investors fall into this tax trap is not because they don't understand math, it's because they are manipulated by their own psychology. Two powerful cognitive biases conspire to make us behave in the most tax-inefficient way possible: loss aversion and its direct consequence, the disposition effect. Loss aversion is one of the most fundamental principles of behavioral economics, first identified by Daniel Kahneman and Amos Tversky. It describes the simple fact that for most humans, the psychological pain of losing a certain amount of money is about twice as powerful as the pleasure of gaining the same amount. Losing $100 feels as bad as gaining $200 feels good. This asymmetry in our emotional response to gains and losses has profound consequences for investor behavior. It leads directly to the disposition effect, a phenomenon where investors have a strong tendency to sell assets that have increased in value too soon, while holding on to assets that have dropped in value for too long. Let's break down how this works. Imagine you have two stocks in your portfolio. Stock A has gone up by 30%. Stock B has gone down by 30%. You need to raise some cash. Your rational brain might analyze the future prospects of both businesses to decide which one to sell. But your emotional brain, driven by loss aversion, works differently. Selling stock B, the loser, would mean realizing the loss. You would have to convert the abstract paper loss into a concrete, painful, real loss. Loss aversion makes this act feel terrible. It's an admission of failure. So the instinct is to hold on, to hope it comes back to even, to avoid the pain of crystallizing that loss. Now consider stock A, the winner. Selling it allows you to realize a gain. This feels good. It's a moment of triumph, an affirmation of your skill. You get a dopamine hit from locking in that profit. The pleasure of this certain gain is far more attractive than the uncertain prospect of future gains, and it allows you to avoid the pain of ever seeing that winner turn into a loser. So the overwhelming emotional impulse is to sell the winner and hold the loser. This behavior is practiced by millions of investors every single day, and it is a catastrophic strategy from a tax perspective. Why? Because every time you sell a winner, you trigger a taxable event. You are voluntarily choosing to write a check to the government. By holding on to the loser, you are sitting on a tax asset, a capital loss that could be used to offset gains elsewhere, but you refuse to harvest it because of the psychological pain involved. The result is a portfolio strategy guided not by financial logic, but by the avoidance of pain and the seeking of pleasure. Investors end up constantly paying taxes on their small wins, while their losing positions languish, offering no tax benefit. This is the tyranny of the taxman, aided and abetted by our own flawed cerebral wiring. Buffett's strategy is the perfect antidote. By viewing himself as a business owner, not a trader, he sidesteps the disposition effect entirely. His decision to sell is based not on whether a stock is up or down, but on whether the long-term prospects of the underlying business have fundamentally changed for the worse. This disconnects the decision-making process from the emotional traps of loss aversion and, as a consequence, creates staggering tax efficiency. To arm yourself against this psychological onslaught, you need to install a new mental model in your brain, a rigid, logical filter that forces you to account for the taxman's cut before you make any move. Let's call this model the tax-adjusted hurdle rate. Its purpose is to make the tax cost of selling a winning investment painfully explicit. transforming it from an afterthought into a primary decision-making criterion. Here's the blueprint for applying it. Every time you are tempted to sell an appreciated asset to buy a new, seemingly better opportunity, you must perform this three-step calculation. Step 1 is to calculate your tax obstacle. Identify the investment you want to sell. Calculate the capital gain, which is your selling price, minus your purchase price. Now, determine your applicable capital gains tax rate. In the United States, this depends on your income and how long you've held the asset. If you've held it for less than a year, you'll pay the short-term rate, which is the same as your ordinary income tax rate, often 25%, 30%, or even higher. If you've held it for more than a year, you'll pay the lower long-term rate, typically 15% or 20%. Multiply your gain by this tax rate. The resulting number is your tax obstacle. It is the amount of money that will be immediately and permanently removed from your portfolio the instant you click Sell. Let's use an example. You own $50,000 of stock X, for which you originally paid $30,000. You have a $20,000 long-term capital gain. Assuming a 15% tax rate, your tax obstacle is $3,000. If you sell, you will receive $50,000 in cash, but $3,000 of it is already promised to the government. You only have $47,000 left to reinvest. Step 2 is to calculate your break-even return. Your new investment, stock Y, now has to work much harder just to get you back to where you were. Your $47,000 must first earn back the $3,000 you paid in taxes. Divide the tax obstacle by your remaining capital. In our example, $3,000 divided by $47,000 is approximately 6.4%. This is your break-even return. Stock Y must appreciate by 6.4% just for you to have the same net worth you had a moment before you sold stock X. Any return below that, and the trade was a guaranteed net loss. Step 3 is to establish the tax-adjusted hurdle rate. This is the final decision filter. You must believe with a high degree of certainty that the new investment, stock Y, will outperform the old investment, stock X, by at least the break-even return. It's not enough for stock Y to be slightly better. It must be substantially better to justify vaulting over the tax hurdle you are voluntarily creating. So, if you believe stock X will continue to grow at 8% per year, you must believe stock Y will grow by at least 14.4% per year, 8% plus 6.4%, just to make the switch worthwhile. Applying this mental model is a game changer. It forces you to stop comparing one investment to another on a pre-tax basis. It introduces the real-world friction of the tax code into your analysis. You will quickly find that very few new ideas are so compelling that they can clear this high hurdle. The tax-adjusted hurdle rate short-circuits the disposition effect and makes you default to the most powerful action in long-term investing, holding on to your winners and letting them compound, shielded from the relentless grasp of the taxman. The path of the 99% is to be completely oblivious to this hidden hurdle. The antithesis of the tax-aware investor is the year-end profit-taker. This is the individual who, as December rolls around, looks at their portfolio with a sense of pride. They see a few stocks that have performed exceptionally well, and they are driven by an overwhelming urge to book the win. This desire is not rooted in a rigorous analysis of the company's future prospects. It's rooted in ego. They want the psychological satisfaction of turning a paper gain into real cash in their account. They want to be able to tell their friends at a New Year's Eve party that they had a, quote, year in the market and point to the specific, realized gains as proof of their investing prowess. They might even post a screenshot of their profitable trade on social media, basking in the validation of likes and comments. They sell their biggest winner of the year on December 28th, and for a few weeks, they feel like a genius. The money sits in their account, a tangible monument to their skill. What they fail to appreciate is that their win came with a silent partner. In January or February, a form arrives in the mail from their brokerage, the 1099-B. This document coldly and clinically lists the taxable gain they just booked, and by April 15th, they will have to write a significant check to the government, sending a chunk of their hard-earned capital away forever. The capital they sent to the IRS is now gone. It cannot grow, it cannot compound, it cannot work for their future. They have willingly traded a piece of their financial freedom for a fleeting moment of psychological gratification. This behavior is a perfect storm of cognitive biases. It's driven by the disposition effect, the urge to sell winners. It's fueled by a desire for social proof and ego validation. And it's enabled by a profound misunderstanding of how wealth is truly built. Wealth is not built by a series of successful short-term sprints. It is built by the long, uninterrupted marathon of compound interest. The year-end profit-taker is constantly interrupting the marathon. They run a great mile, then stop for a long break to celebrate, giving up all their momentum. The intelligent investor, by contrast, understands that the finish line is decades away. They ignore the short-term applause and focus on keeping their capital invested and working, shielded from the unnecessary and corrosive effects of capital gains taxes. The year-end profit-taker is playing a game against themselves and the taxman, a game they are almost guaranteed to lose over time. The direct financial connection between a low-turnover, tax-efficient strategy and your final net worth is one of the most dramatic illustrations in all of personal finance. It reveals that the difference between being a millionaire and a multimillionaire often has less to do with picking better stocks and more to do with simply letting them grow. Let's conduct a side-by-side comparison of two investors to see how this plays out financially. We will call them Anna and Ben. Both start with $100,000. Both are excellent investors, capable of finding investments that generate a 12% annual return. They have identical skill. The only variable is their approach to taxes. Anna is a business owner-investor in the Buffett mold. She buys a portfolio of wonderful companies and holds them for the long term. Her strategy is to only sell when a company's fundamentals have seriously deteriorated. She doesn't book wins. As a result, she pays virtually no capital gains tax year to year. Her $100,000 is allowed to compound at the full 12% annual rate. Ben is the active trader. He also generates 12% per year, but he does so by trading in and out of positions. He likes to lock in his gains. At the end of each year, he sells his winners, realizing a profit. Because he holds his positions for less than a year, he pays the higher short-term capital gains tax rate on his profits. Let's assume Ben is in a federal and state tax bracket that results in a combined 30% tax on his short-term gains. So each year, his 12% gain is immediately reduced by 30%. The tax on his gain is 3.6%, 12% asterisk 0.30. This means his actual after-tax return is only 8.4% per year, 12% to 3.6%. Now let's fast forward 30 years. Anna, the buy-and-hold investor, allowed her $100,000 to compound at 12% per year, uninterrupted by taxes. Her portfolio grows to a staggering $2, $995, $992. She has become a multimillionaire. The vast majority of this value is an unrealized capital gain. She would only pay tax if and when she decides to sell, and even then, it would be at the lower long-term rate. Ben, the active trader, saw his $100,000 compound at his net after-tax rate of 8.4% per year. After 30 years, his portfolio grows to $1, $136, $548. This is a respectable sum, to be sure, but it is less than half of what Anna accumulated. The difference between them is over $1.8 million. Let that number sink in. Over $1,800,000. Where did that money go? It went to the government. It was the price Ben paid for his constant activity, for his need to book wins. He and Anna had the exact same level of skill, but Anna's strategy allowed her to keep her capital and the government's deferred tax money working for her. Ben's strategy forced him to send a portion of his army of dollar bills away to the taxman every single year, depleting the force that was fighting for his financial freedom. This is not a hypothetical exercise. This is the mathematical reality that underpins the entire philosophy of long-term investing. It proves that a disciplined, low-turnover approach is not a single strategy. It is a massive and enduring financial advantage. It is the secret that separates the merely successful from the truly wealthy. Even if an investor manages to minimize their trading fees and master the discipline of tax deferral, there is a deeper, more primal force that can sabotage their journey to wealth: the irresistible urge to simply do something. In moments of uncertainty, volatility, or even just boredom, the human brain craves action. Doing nothing feels like neglect, like a dereliction of duty. This powerful impulse is the root of more investment mistakes than perhaps any other single factor. And Warren Buffett's most famous mental model was designed specifically to conquer it. The story goes that Buffett, when speaking to business school students, would often propose a simple thought experiment. "I could improve your ultimate financial welfare," he'd say, "by giving you a ticket with only 20 slots in it. These 20 punches represent all the investment decisions you get to make in your entire lifetime." Imagine the weight of that. You have a multi-decade investing career ahead of you, and you are limited to just 20 decisions. You can't waste a single punch on a whim or a hot tip. Every single decision has to be the result of your absolute best thinking, your deepest research, and your highest conviction. The punch card analogy is a brilliant device for shifting an investor's mindset. It immediately reframes the game. Investing is no longer about finding a lot of good ideas. It's about finding a tiny handful of truly great ideas. It forces you to raise your standards to an almost impossible level. You would no longer buy a stock because a talking head on television recommended it. You would no longer buy a company you didn't fully understand. You would no longer make a move just because the market was volatile and you felt like you had to react. With only 20 punches, you would be forced to wait patiently for the perfect pitch, the one, obvious, fat pitch, right down the middle of the plate. And when that opportunity came along, you would swing for the fences, allocating a significant amount of capital to it, because you might not see another one like it for a very long time. This single anecdote encapsulates the battle against what psychologists call action bias. It is the ultimate expression of the idea that in investing, restraint is a greater virtue than aggression, and that the quality of your decisions matters infinitely more than the quantity. A lifetime of 20 brilliant, well-timed punches will build a fortune far greater than a lifetime of 1,000 mediocre, impulsive ones. The punch card philosophy is a direct assault on two of the most powerful and destructive cognitive biases that haunt the human mind: action bias and the illusion of control. Action bias is our innate tendency to favor action over inaction, even when inaction is the more rational course. We are creatures of movement, problem solvers by nature. When faced with an ambiguous or threatening situation, our default setting is to intervene. We believe that doing something is always better than doing something. This instinct may have served our ancestors well on the savannah when faced with a predator. Running was usually better than standing still. But in the modern complex world of the stock market, this instinct is a catastrophic liability. Researchers have demonstrated this bias in a fascinating study of professional soccer goalies during penalty kicks. Statistically, the optimal strategy for a goalie is to stay in the center of the goal. But in over 90% of kicks, goalies dive to the left or to the right. Why? Because the social and personal pain of letting in a goal while standing still is perceived as far greater than the pain of letting in a goal while making a valiant athletic dive. Doing something, even if it's the wrong thing, feels better. For an investor, watching the market fall and doing nothing feels agonizing. It feels like you are letting the disaster happen. The urge to sell, to move to cash, to do something, is overwhelming, even though decades of data show that the best course of action during a downturn is usually to remain invested, or even buy more. This is compounded by the illusion of control. This is the belief that we can influence outcomes that are, in fact, beyond our control. By clicking buttons, reading charts, and moving money between accounts, the active investor feels like they are piloting their financial ship. They believe their actions are directly shaping their destiny. In reality, they are often just a sailor on a tiny raft in a vast ocean, furiously paddling while being carried by a current they cannot influence. The market's short-term movements are chaotic and unpredictable. The illusion that your frantic trading is exerting control over this chaos is just that, an illusion. Brokers and financial media platforms are masters at exploiting these biases. They create an environment of perpetual urgency. Breaking news, market alerts, and real-time price quotes are all designed to trigger your action bias and reinforce your illusion of control. They want you to feel that if you are not constantly reacting, you are falling behind. Buffett's punch card mental model is a psychological shield against this manipulation. It forces a radical shift in perspective. It tells you that the default action should always be inaction, and that action should be reserved for the rarest and most extraordinary of circumstances. It replaces the illusion of control with the reality of profound selectivity. To internalize this principle and protect yourself from the siren song of action, you need a practical system, a circuit breaker that you can install in your own decision-making process. This mental model is the mandatory waiting period. It is a simple but profoundly effective rule designed to separate a genuine investment insight from a fleeting emotional impulse. The blueprint is as follows. Anytime you feel a strong urge to make a non-scheduled investment decision, to buy a stock you just heard about, or to sell a stock because of a scary headline, you must immediately invoke the waiting period. Do not log into your brokerage account. Do not place a trade. Instead, take out a single sheet of paper or open a new document. At the top, write down the date and the proposed action. Proposal: buy 100 shares of XYZ Corp. Or proposal: sell all shares of ABC Corp. Step 1 is to articulate your thesis. On that page, you must write down, in clear and simple language, the precise reason for this proposed action. If it's a purchase, why are you buying it? What is your rational case for why this asset will be worth more in the future? It cannot be because the stock is going up or because so-and-so recommended it. It must be a business-based reason. I am buying XYZ Corp. Because its new product line is poised to capture significant market share, which I believe will increase its earnings per share by 50% over the next 3 years. If it's a sale, the same logic applies. Why are you selling? I am selling ABC Corp. Because its primary competitor just released a superior product that I believe will permanently erode ABC's profit margins. This act of writing forces you to clarify your thinking and expose weak emotional reasoning. Step 2 is to impose the waiting period. Once your thesis is written, you file it away. You are now forbidden from acting on this proposal for a predetermined period of time. For most investors, a 14-day or 30-day waiting period is effective. This period must be non-negotiable. Mark the end date on your calendar. During these weeks, you are free to conduct more research, but you cannot execute the trade. The purpose of this cooling-off period is to allow the emotional urgency, the fear or greed that triggered the initial impulse, to fade. Emotions are powerful, but they are also transient. Step 3 is the final review. When the waiting period is over, you take out your original one-page thesis and read it again. Now, with the benefit of time and emotional distance, ask yourself, is this thesis still valid? Does it still seem as compelling as it did a few weeks ago? Has any new information emerged that contradicts it? You will be astonished at how often a proposal that felt incredibly urgent and brilliant in the heat of the moment now seems mediocre or even foolish. The mandatory waiting period acts as a filter. It catches the vast majority of your bad, impulsive ideas, which are driven by action bias, and allows only the most well-reasoned, high-conviction ideas to pass through. It is the practical application of the punch card philosophy, ensuring that your precious few punches are saved for the opportunities that truly matter. The world is full of people who live by the opposite creed. The antithesis of the selective, patient investor is the CNBC junkie. Their investment philosophy is not built on a foundation of business analysis and long-term thinking, but on a constantly shifting bedrock of media-driven narratives and expert opinions. Their day is a whirlwind of financial information consumption. They wake up to a market summary email, listen to a financial news podcast on their commute, have stock tickers running on a corner of their work computer all day, and unwind by watching hours of cable financial news in the evening. They can tell you what the market did in the last hour, but they can't tell you how the companies in their own portfolio actually make money. The CNBC junkie lives in a state of perpetual reactivity. When a well-dressed analyst comes on television and pounds the table for a hot tech stock, the junkie feels an immediate and powerful sense of FOMO, fear of missing out. They scramble to their trading app and buy a few shares, not because they've studied the company's balance sheet, but because the analyst seemed confident and the story was compelling. An hour later, a different segment airs, this one featuring a gloomy economist predicting an imminent recession. A jolt of fear courses through the junkie. They look at their portfolio, suddenly seeing risk in every position. They sell a solid blue-chip company they've owned for years, not because its business has changed, but because the emotional climate has. Their portfolio is not a curated collection of businesses. It is a chaotic reflection of the last 72 hours of the news cycle. It churns constantly. They buy high in moments of media-induced euphoria and sell low in moments of media-induced panic. They are always busy, always making moves, always managing their money. They mistake this flurry of activity for progress. They mistake being well-informed about the day's market chatter for having genuine insight. They are playing the game that the financial media and brokerage houses want them to play, a game of high volume, high emotion, and high costs. They are the person who uses up all 20 of their lifetime punches in a single year, wasting them on flimsy ideas and emotional reactions. Their path is not one of wealth building, it is one of wealth destruction. A slow and steady transfer of their capital to the more patient and disciplined participants in the market. They are perpetually stuck on a hamster wheel of action, running faster and faster but never actually getting any closer to their goal of financial freedom. The direct financial consequence of this action bias is a concept well known in the world of professional portfolio management: the penalty of high turnover. A portfolio's turnover ratio is a measure of how frequently its holdings are bought and sold over a year. A ratio of 100% means that, on average, the entire portfolio is sold and replaced once every year. A ratio of 10% means only a tenth of it is replaced. The evidence is overwhelming. On average and over the long run, high turnover investment funds consistently and significantly underperform low turnover funds. This isn't just a theory, it's a quantifiable financial drag. Let's break down the hidden costs that are directly created by a high turnover ratio, costs that go beyond the simple commissions and spreads we discussed earlier. First, there's the cost of market impact or slippage. When you execute a large trade, your own action can move the price of the stock against you. If you are buying, your demand can push the price up slightly before your order is fully filled. If you are selling, your supply can push it down. For a small investor, this might be a few cents per share, but for an active trader making numerous moves, these cents add up to a significant hidden tax on every action. Second, and far more importantly, is the tax inefficiency we detailed earlier. A high turnover strategy is, by its very nature, a tax inefficient strategy. It almost guarantees that any gains will be short-term, subjecting them to the highest possible tax rates. A fund with a 100% turnover ratio is essentially crystallizing all of its gains and losses every single year, maximizing its annual tax bill and destroying the powerful benefits of tax-deferred compounding. Let's put some hard numbers to this. Studies by Morningstar and other financial research firms have repeatedly shown that, on average, high portfolio turnover can reduce an investor's annual returns by anywhere from 1% to 2.5% when all associated costs, commissions, spreads, market impact, and especially taxes are factored in. So, let's take two portfolios that both hold stocks that generate a 10% gross annual return. Portfolio A is a low-turnover, Buffett-style portfolio with a 10% turnover ratio. Its total cost drag from its minimal activity is just 0.25% per year. Its net return is 9.75%. Portfolio B is a high-turnover CNBC junkie portfolio with a 100% turnover ratio. Its total cost drag, including the heavy tax inefficiency, is 2% per year. Its net return is only 8%. Over a 40-year period, a $100,000 investment in Portfolio A grows to over $4.2 million. The same investment in Portfolio B grows to just $2.1 million. The difference is more than $2 million. It is a doubling of one's final net worth. This is the direct, quantifiable financial power of conquering action bias. It is the monetary reward for adopting the punch card mentality, for choosing deliberate inaction over frantic, costly, and ultimately self-defeating activity. The numbers don't lie. In the long run, the market lavishly rewards the patient and systematically punishes the hyperactive. To truly escape the gravitational pull of frictional costs and psychological biases, an investor must undergo a profound and fundamental shift in their identity. They must stop seeing themselves as a renter of stocks and start seeing themselves as an owner of businesses. This is the absolute core of the Buffett-Munger philosophy, the master key that unlocks all the other principles. And no story better illustrates this mindset shift than their 1972 acquisition of See's Candies. At the time, Berkshire Hathaway was still primarily a struggling textile company. Buffett was looking to deploy its capital into better businesses. Through a banker, he was introduced to the See family, who were looking to sell their iconic California-based candy company. From the very beginning, Buffett and his partner, Charlie Munger, approached the deal not as a stock market transaction, but as if they were private entrepreneurs buying a family business to run for the next 50 years. They didn't start by looking at a stock chart. There was no stock chart to look at. Instead, they flew to California and walked into See's Candy shops. They observed the customers, who were fiercely loyal and happily paid a premium price for the product. They tasted the candy, recognizing its quality. They talked to the management and understood the company's culture. They were conducting what we would now call scuttlebutt research. What they discovered was a business with a magnificent economic moat. The See's brand was so powerful in the minds of its customers, especially on the West Coast, that it commanded a durable competitive advantage. People bought See's for holidays and special occasions not just because the candy was good, but because it was a tradition. This brand loyalty gave the company tremendous pricing power. They could raise prices year after year to offset inflation, and their customers wouldn't even think of switching to a cheaper alternative. The deal almost fell through. The See family wanted $30 million, and Buffett, still anchored to his cigar butt style of buying statistically cheap assets, was only willing to offer $25 million. It was Charlie Munger who pushed him, famously saying that a truly wonderful business at a fair price is better than a fair business at a wonderful price. They paid the $30 million. In the decades that followed, See's Candies sent hundreds of millions and eventually billions of dollars in profits back to Berkshire Hathaway. It became the prototype for the kind of business they would seek to own, a company with a strong brand, pricing power, and loyal customers. The lesson here is profound. Buffett and Munger weren't buying a piece of paper to be traded, they were buying a business. They were thinking about its cash flow, its competitive position, and its long-term future. This business owner mindset is the ultimate antidote to the short-term, hyperactive, ticker-focused mentality of the average market participant. When you own a business, you don't think about selling it because of a bad jobs report or a rumor about interest rates. You think about how to make it stronger over the next decade. This is the mindset you must adopt, even when you're only buying a tiny fraction of a company through a single share of stock. The psychological mechanism that makes this mindset shift so powerful is rooted in two principles: the endowment effect and mental accounting. The endowment effect is our tendency to ascribe more value to things simply because we own them. In a classic experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded to part with the mug was consistently and significantly higher than the price other participants, who were not given a mug, were willing to pay for one. The mere act of ownership created an emotional attachment that increased its perceived worth. When you think of yourself as a stock trader, you don't feel a true sense of ownership. You are merely holding a ticker symbol, a fungible electronic blip, that you are ready to swap for another at a moment's notice. There is no endowment effect. But when you consciously shift your mindset to that of a business owner, you trigger this psychological principle. You are no longer just holding shares of Apple. You are a part owner of the world's most valuable consumer electronics and services business. You feel a sense of stewardship. This makes you far less likely to sell it on a whim or a panic. You would only part with your piece of this incredible business if something fundamentally threatened its long-term viability. This connects directly to the concept of mental accounting, which is our tendency to place different values on money depending on its source or our intention for it. People will splurge with windfall money from a bonus or a lottery ticket, but be extremely frugal with their regular salary, even though a dollar is a dollar. As a trader, you might place your investment capital in a mental account labeled speculation money. This makes it psychologically easier to take risks and churn the portfolio. But when you adopt the business owner mindset, you recategorize that capital into a mental account labeled My Business Equity. This account is sacred. It is not for gambling. It is for long-term conservative growth. It changes your entire relationship with the capital. You move from a mindset of how can I flip this for a quick profit to how can I be a good steward of this capital and allow it to compound for decades. This shift from a trader's mentality to an owner's mentality is not just a semantic trick, it is a profound psychological rewiring. It changes your time horizon from days and weeks to years and decades. It changes your focus from price fluctuations to business fundamentals. It provides the deep, emotional conviction necessary to hold on through the market's inevitable storms and to resist the siren call of constant wealth-destroying activity. To operationalize this mindset, to turn it from a vague philosophy into a concrete decision-making tool, you can use a powerful mental model called the private equity buyer test. This test forces you to evaluate a potential stock purchase with the seriousness and rigor of a professional investor looking to acquire an entire company. Before you buy even a single share of a publicly traded stock, you must ask yourself one simple, clarifying question. If I had access to unlimited capital, would I be happy to buy 100% of this business at its current market price, take it private, and own it for the next 10 years with no ability to sell it? This question acts as an incredibly effective filter. It immediately destroys the short-term speculative mindset. If you can't sell it for 10 years, the daily stock price fluctuations become completely irrelevant. The only thing that matters is the stream of cash the business itself will generate over that decade. To answer this question honestly, you are forced to think like a true business owner. First, you have to understand the business model. How does this company actually make money? What are its products and services? Who are its customers? You can no longer get away with just knowing the ticker symbol. Second, you have to assess its competitive advantage, or economic moat. What protects this business from competitors? Is it a powerful brand like See's Candies? Is it a network effect like Facebook or Visa? Is it a low-cost production advantage like Geico? A business with no moat is unlikely to survive and thrive for 10 years. Third, you must evaluate the management team. Are they honest and capable? Do they think like owners themselves, or are they just looking to maximize their own short-term compensation? Reading their annual letters to shareholders and listening to their conference calls becomes essential. Finally, you have to determine a reasonable price. You must assess whether the future stream of earnings you expect to receive provides a satisfactory return on the total price you would be paying for the entire company. If the answer to the private equity buyer test is a resounding yes, then buying a small piece of that company in the form of shares is a logical and well-founded decision. You are, in effect, becoming a silent partner in a business that you would be thrilled to own outright. But if the answer is no, or even a hesitant maybe, then you must pass on the opportunity. If you wouldn't be willing to own the whole farm, you have no business buying a single cow. This mental model elevates your investment process from amateur speculation to professional-grade capital allocation. It ensures that every one of your 20 lifetime punches is used on a business you understand deeply and in which you have profound long-term conviction. The antithesis of the business owner is the technical trader. This individual represents the ultimate detachment from the reality of the underlying business. To them, the stock market is not a venue for participating in the growth of the real economy. It is a giant video game, a world of patterns and signals completely divorced from concepts like profit margins, return on equity, or corporate leadership. The technical trader's world is the chart. They spend their days staring at candlestick patterns, looking for formations with names like head and shoulders tops, double bottoms, and bullish engulfing patterns. They overlay their charts with a dizzying array of indicators: moving averages, relative strength indexes, Bollinger Bands. They believe that the entire story of a company's future is encoded in the history of its price movements. To the technical trader, the name of the company is almost irrelevant. A chart of Amazon is functionally identical to a chart of a speculative biotech company with no revenue. Both are just lines on a screen, patterns of greed and fear to be exploited. They would never dream of reading a company's annual report. That's for fundamental investors, a group they often view as slow and old-fashioned. Why bother understanding a company's debt-to-equity ratio when a golden cross, the moment a short-term moving average crosses above a long-term one, can tell you when to buy? This approach is the epitome of renting a stock. There is zero sense of ownership, zero connection to the business. The holding period is determined not by the long-term prospects of the enterprise, but by the emergence of a countersignal on a chart. They might buy a stock in the morning and sell it in the afternoon because an indicator moved into overbought territory. They are the ultimate in and outers, constantly transacting based on abstract patterns. This detachment from business reality is incredibly dangerous. A strong, growing business can experience terrifying price declines during a market panic. The business owner, who understands the company's intrinsic value, sees this as a buying opportunity. The technical trader, who only sees a chart whose patterns have broken down, sees a sell signal and liquidates their position at the point of maximum pessimism. Conversely, a failing business can see its stock price skyrocket in a speculative bubble. The business owner avoids it, knowing there is no underlying value. The technical trader jumps in, seeing only upward momentum, and is often left holding the bag when the bubble inevitably bursts. The technical trader has abdicated their responsibility to think. They have outsourced their decision-making to a set of mechanical rules and squiggly lines, ignoring the single most important driver of long-term investment returns: the fundamental performance of the underlying business. The direct financial connection of adopting a business owner mindset is twofold. First, it dramatically improves the quality of the assets you choose to own. Second, it provides the psychological fortitude needed to hold those assets long enough for their quality to translate into extraordinary returns. When you think like a business owner, your selection criteria change completely. You stop hunting for stocks that might pop next week and start searching for businesses that will be dominant in their industry a decade from now. This leads you to favor companies with durable competitive advantages. On a balance sheet and income statement, these are the businesses that exhibit consistently high returns on invested capital, fat profit margins, and growing free cash flow. They are companies that can fund their own growth without taking on excessive debt. These are the compounding machines, the businesses that can reinvest their profits at high rates of return, creating a virtuous cycle of value creation. A portfolio built of these high-quality assets will, over the long term, almost certainly outperform a portfolio of mediocre, speculative, or cigar-butt companies. The financial result is a higher baseline rate of return before any costs are even considered. You are simply fishing in a better pond. But perhaps the more powerful financial connection is behavioral. The conviction that comes from deep business analysis is what allows you to hold on during the terrifying market drawdowns that are an inevitable part of the investing landscape. When the market falls 30%, the stock renter, who bought based on a tip or a chart pattern, feels nothing but fear. Their thesis is gone. They sell in a panic, locking in devastating losses. The business owner, however, has a different experience. They have done the private equity buyer test. They understand the company's long-term value. They see the 30% price drop not as a catastrophe, but as an opportunity. The market is offering them the chance to buy more of a wonderful business at a 30% discount. Their conviction allows them to hold or even add to their position at the very moment when the path of the 99% is to sell. This single behavioral difference, selling in a panic versus holding or buying in a panic, is responsible for a massive divergence in long-term financial outcomes. Holding through just 2 or 3 major bear markets without panicking can be the difference between achieving your financial goals and suffering a permanent impairment of your capital. Thus, the business owner mindset provides a powerful 1-2 punch. It helps you select superior assets, and it gives you the behavioral strength to reap the full, long-term rewards of owning them. It is the operating system that makes the entire low-cost, tax-efficient, patient strategy possible. When you combine all these principles, the avoidance of frictional costs, the mastery of tax deferral, the conquest of action bias, and the adoption of a business owner mindset, you unleash the single most powerful force in the financial universe. You create the ideal conditions for the uninterrupted magic of compound interest. This is the final pillar, the grand payoff for all the discipline and patience that precedes it. There is no greater living testament to this power than Warren Buffett's own net worth. If you look at a chart of his wealth over his lifetime, it is one of the most astonishing things you will ever see. From his teens to his late 30s, the line is almost perfectly flat, barely lifting off the x-axis. He was accumulating capital, to be sure, but the numbers were not yet astronomical. Through his 40s, the line begins to curve upward, but it is still a gentle slope. The truly mind-bending part of the chart begins around his 50th birthday. From that point on, the curve becomes a nearly vertical line. It goes parabolic. The numbers become almost incomprehensible. The vast majority, over 99% of Warren Buffett's immense fortune, was earned after he qualified for Social Security. This is not because he became a dramatically better investor in his later years. It's because the enormous base of capital he had patiently accumulated and, crucially, had left undisturbed, was now growing by staggering absolute amounts each year. The eighth wonder of the world, as Einstein is said to have called compound interest, was now working its magic on a colossal scale. This story is the ultimate foundational anecdote because it reveals the secret ingredient of compounding: time, but not just time, uninterrupted time. Every time an investor pays an unnecessary commission, they are stealing a little bit of fuel from their compounding engine. Every time they voluntarily pay a capital gains tax, they are taking a portion of their capital out of the machine and setting it on the sidelines forever. Buffett's genius was his lifelong obsession with keeping the machine running at full capacity, with as much capital as possible, for as long as possible. He understood that the biggest gains don't come in year 5 or year 10. They come in year 30 and year 40, when the exponential growth curve becomes a cliff face. His personal financial journey is a living monument to the supercharger effect of letting a high-quality portfolio grow without the constant interruption of costs, taxes, and unnecessary activity. The primary reason we fail to harness this incredible power is a deeply ingrained psychological flaw known as hyperbolic discounting. Our brains are not wired for long-term gratification. We have a powerful primal preference for immediate rewards over larger, delayed rewards. This is the bias that makes it difficult to save for retirement or stick to a diet. The immediate pleasure of spending money or eating a donut is far more tangible and compelling to our brains than the abstract, distant reward of financial security or better health. In a famous experiment, subjects were offered a choice: receive $100 today or $120 in 1 month. The vast majority chose the $100 today. The immediate reward was too tempting to pass up, even though the delayed option represented a 20% monthly return on investment, an annualized return that would make any hedge fund manager a legend. Compounding is the ultimate delayed reward. Its most spectacular effects are decades in the future. The difference in your portfolio's value between year 7 and year 8 is small. The difference between year 37 and year 38, however, can be more than your entire initial investment. But our hyperbolic discounting brain struggles to appreciate this. It sees the small, immediate thrill of a successful trade. It feels the immediate satisfaction of booking a win and triggering a tax liability. These small, immediate dopamine hits are more powerful to our primitive brain than the massive but distant reward of a fully compounded retirement nest egg. Successful long-term investing is therefore a battle against our own nature. It requires the conscious, deliberate use of our rational prefrontal cortex to override the impatient, impulsive demands of our ancient limbic system. We have to force ourselves to choose the larger, later reward. We have to learn to find satisfaction not in the thrill of the trade, but in the quiet, stoic discipline of inaction. We have to rewire our brains to see the constant churn of a trading account not as progress, but as a self-inflicted wound, a foolish sacrifice of a magnificent future for a trivial present. Overcoming hyperbolic discounting is the final psychological hurdle. Those who can do it unlock the possibility of exponential wealth. Those who cannot are doomed to a life of linear returns, constantly trading away their future for the fleeting pleasures of the now. To win this battle against your own impulsive brain, you must architect an environment that makes patience the path of least resistance. You need a mental model for behavior change, a system that makes the optimal long-term strategy the easiest short-term option. We can call this model the do-nothing default. It's about systematically removing the sources of temptation and making inactivity automatic. Here is the blueprint for its implementation. Step 1 is to automate your contributions. The single most important decision in your wealth-building journey is your savings rate. Make this decision once, and then make it automatic. Set up a recurring, automatic transfer from your checking account to your investment account every single payday. This removes willpower from the equation. The money is invested before you even have a chance to think about spending it. This is the foundation of passive, disciplined accumulation. Step 2 is to curate your information diet. Unsubscribe from the market news alerts. Delete the stock ticker app from your phone's home screen, or better yet, delete it entirely. Stop watching cable financial news. These information sources are not designed to make you a better investor. They are designed to trigger your action bias and sell advertising. Replace that time with reading annual reports, industry journals, or classic books on long-term investing. Shift from consuming noise to acquiring knowledge. Step 3 is to schedule your inaction. Instead of checking your portfolio every day, which only exposes you to meaningless volatility and tempts you to act, set a specific, infrequent schedule for review. For most long-term investors, reviewing your portfolio once every 6 months, or even just once a year, is more than sufficient. Put these review dates on your calendar. This transforms portfolio review from a reactive, emotional habit into a planned, rational event. Between these dates, your default setting is to do absolutely nothing. Step 4 is to create a policy, not a plan. A plan is something you hope to do. A policy is a rule you follow. Create a personal investment policy statement. Write down your goals, your time horizon, your asset allocation strategy, and, most importantly, the specific conditions under which you will allow yourself to buy or sell an asset. This document becomes your constitution. When you feel the emotional urge to act, you must first consult your policy. If the action doesn't align with your pre-committed rules, you are forbidden from taking it. By implementing the do-nothing default, you are using the power of defaults and pre-commitment to protect yourself from your own worst instincts. You are making patience easy and impulsivity difficult. You are creating the quiet, undisturbed space necessary for the compounding supercharger to do its magnificent, wealth-creating work. The antithesis of this patient, systematic approach is the tinkerer. This is the investor who simply cannot leave their portfolio alone. They see themselves as a master gardener, constantly tending to their plants. But what they are really doing is pulling up the flowers every day to see if the roots are growing. The tinkerer is obsessed with optimization. They read an article about a new asset allocation model and immediately feel the need to rebalance their entire portfolio to match it. They see one of their stocks go up 20% and feel an overwhelming urge to trim the position to take some profits off the table. They see another stock fall 10% and decide to, quote, average down, adding more capital to a potentially weakening position. Every action is justified by a plausible-sounding rationale, but the net effect is a portfolio in constant, low-level turmoil. They are always making small adjustments, small trades, small moves. They believe they are adding value, fine-tuning their engine for maximum performance. In reality, every tinker is an interruption. Every rebalance is a potential tax event. Every trim is a decision to take capital away from your best-performing assets. Every averaging down is a potential violation of the principle of letting your winners run and cutting your losers. The tinkerer's portfolio suffers from a death by 1,000 cuts. Each small transaction incurs a tiny commission. Each sale of a winner generates a small tax bill. Each move is a small disruption to the silent, invisible process of compounding. Over many years, the cumulative effect of this constant tinkering is devastating. It is the financial equivalent of trying to build a giant snowman by constantly taking it apart and re-rolling the snowballs. You expend a massive amount of energy, but the final result is far smaller than if you had simply added more snow and let it be. The tinkerer lacks the faith and the patience to let a well-designed system work. Their need for control, their action bias disguised as prudence, becomes their undoing. They fail to understand the profound wisdom in the old investing adage, don't just do something, stand there. Let us now put it all together. The direct financial connection of this final pillar is the ultimate bottom line of your entire investing life. It is the mathematical proof of the immense cost of interruption and the staggering reward of patience. We can visualize this with a, quote, waterfall chart of returns. Imagine two investors who both start with a portfolio of assets that are destined to generate a gross return of 10% per year. Let's start with the active trader, the tinkerer, the person who ignores all the principles we have discussed. They start with their 10% gross return. The first waterfall deduction is for frictional costs. Their frequent trading commissions and spreads shave off 1.0% per year. Their return is now 9.0%. The next, and much larger, deduction is for tax inefficiency. Their high turnover and constant realization of short-term gains create a tax drag that costs them another 2.5% per year. Their real net of tax return is now just 6.5%. Over a 40-year period, a $100,000 investment compounding at 6.5% per year grows to approximately $1,280,000. Now let's look at the patient business owner investor. They also start with the same 10% gross return. Their first waterfall deduction is for their minimal frictional costs. Their low turnover strategy costs them just 0.1% per year. Their return is now 9.9%. The next deduction is for taxes. Because they rarely sell, their tax drag is almost zero on a year-to-year basis. The capital grows almost entirely tax-deferred. Their net, pre-tax compound rate is 9.9%. Over that same 40-year period, their $100,000 investment compounds to over $4.3 million. The final result is not even close. The patient investor who simply avoided the interruptions ends up with over $3 million more. They have more than triple the wealth of the active investor, despite starting with the exact same raw material, the ability to find investments that grow at 10%. That $3 million difference is the ultimate price of hyperactivity. It is the combined, compounded cost of commissions, spreads, and, most of all, taxes. It is the tangible, life-altering financial reward for understanding that wealth is not created by frantic action, but by allowing the unstoppable power of uninterrupted compounding to work on your behalf, year after silent year. This is the final promise of the Buffett philosophy, a framework for turning off the noise, avoiding the traps, and letting the simple, powerful arithmetic of ownership carry you toward true and lasting financial freedom. You have just spent this time acquiring a powerful lens, a new way of seeing the financial world. You now possess the ability to see the invisible taxes, the hidden fees, and the psychological traps that are specifically designed to drain the wealth of 99% of market participants. You understand that the frantic activity your broker encourages is a tax on your future, and that disciplined inaction is often the most profitable move you can make. You have mastered the defensive part of the game. But understanding the cost of friction and the virtue of patience is only the first half of the equation. Warren Buffett's true genius was not just in avoiding the thousands of mistakes the average investor makes. It was in the system he used to identify the rare, once-in-a-lifetime opportunities where he should act. His punch card philosophy of making very few, very large, and very high-conviction bets is a completely different network of mental models. It's the offensive strategy that complements the powerful defense you've just learned. The question shifts from, how do I stop losing, to how do I find the handful of opportunities that are worth a precious punch on my card. The video that is now appearing on your screen is designed to be the next piece of that map. It is the essential bridge from what not to do to the far more difficult question of what to do. It illuminates the framework for identifying the kinds of high-quality businesses with durable economic moats, the very ones that make a low-turnover buy-and-hold strategy so immensely powerful and profitable over the long run. You have already proven that you are not like the 99% who skim headlines and chase hot tips. You have invested your most valuable asset, your time, to understand the system at a deep level. Do not stop now. The path to becoming a true business owner, not a perpetual stock renter, continues with the knowledge contained in that next video. Complete your mental arsenal. Continue your ascent, click and take the next step.